Well, we are knee deep into August, and ever since the Trump administration took office in January, it's been nothing short of mayhem and havoc for the retail sector. Tariff policies have been, upending the retail landscape, and right now, families are gearing up to back to school, and prices are finally starting to bear the brunt of the impacts that we've been talking about all year. So thank you so much, Omair, for sitting down with me today to have a chat about what all this means for the retail sector as we're gearing up into the very important back half of the year.
Thank you, Jessica, for having me.
Of course. So let's get down to it. How are the Trump administration's tariffs and the trade policy shifts impacting consumer prices right now? What are you seeing amongst your own clientele?
Yeah, look, I actually want to take us back a little bit, maybe to the beginning of the year. At the turn of last year's administration change, there was a lot of optimism and euphoria because of this administration's previous, 4-year policies that were very business friendly, very consumer friendly, and there was a lot of excitement, I think, across both Wall Street and Main Street that this is going to be an incredible 4 years that we're going into. I think that sentiment quickly changed when a couple of interesting policy narratives came about. The first was, hey, we're obviously operating under unsustainable amounts of debt that the United States has, which is a true fact, and that is something that we have to all kind of control and manage and handle. But the way we want to go do that is by making very radical cuts to government spending, but then we also want to take very radical policies combined with that on the way we tariff imports across the world. And both of those things seem pretty reasonable ideas when you're trying to manage the national debt. But the radicalness of how and the volatility and the unpredictability with which these policy narratives and policy execution plans were rolled out has created mayhem and havoc. I'm going to use your words here. I think a lot of the retailers and consumers in Q1 started bracing for what these tariffs would do for them and how they were going to impact supply chains and how they were going to impact prices. And we saw sort of an interesting trend in Q1 that quickly shifted in the opposite direction in Q2. What we saw in Q1 was the consumer being smart and saying, hey, if I want to buy something, now is the time for me to buy it because tariffs are going to increase prices. And they were right about it. About half of our customers pretty openly stated that we are going to increase prices. We're unable to take all of the tariff hit, and neither are their manufacturers per se. As we saw the consumers continuing to invest, more in their buying because they wanted to get ahead of the pricing increases, what we saw was a pretty good Q1. Although this was sort of starting to combine with how retailers were starting to think about their own inventory positions. Now, imagine you're a retailer that's importing from a country where tariffs are 20% today. Well, tomorrow they could be 30%, and day after tomorrow they could be 10%. So there was a paralysis created for a lot of retailers because they were kind of not sure if I should buy a lot of inventory now to get ahead of the tariffs, or am I buying something now and paying 25% when day after tomorrow it will be 15%. So what did retailers started to do? A lot of the retailers, they slowed down their promotions. They slowed down their promotions because they're trying to preserve their inventory. Why are they trying to preserve their inventory? Because they're trying to maintain their inventory levels without having to buy something that now comes to the United States and then having to pay a lot more for it versus maybe waiting 2 weeks and seeing if it's going to go down because an agreement's going to be cracked, right? So if you think about retail, right, I've been in the retail sector for over 20 years. Only one thing matters in the success of retail. It's momentum. You acquire customers, you keep them, and you acquire more customers, and your existing customers keep buying from you. The minute retail starts losing momentum, you start seeing a downward trend. Now,
Right.
combine that with inflationary pressures on the supply chain side, combine that with higher interest rate environment that we're operating under, combine that with a consumer that is already getting shaky because of historic levels of credit card debt, and you've got things starting to kind of fall apart in Q2. As a matter of fact, when the May, June job reports came out, I was very surprised. It didn't make sense to me, and I'm actually glad in July they went back and looked at it and it corrected itself. But I think we're in for a rough second half unless something changes pretty quickly.
Absolutely. And, we saw tariffs up to 145% on China. In that kind of climate, you really can't blame retailers for sort of hitting pause, being a little cautious, and hoping, hoping against hope that maybe it'll go back down. So it's really been a really crazy year so far. But right now,
Yeah,
oh, go ahead.
no, I was just gonna say, look, I just want to state this out loud. Um, Having tariffs is not a bad thing. It is time that there is reciprocal tariffs on countries that have been taxing the United States manufacturers in an unfair way. That is absolutely a policy that needs to be implemented.
Right.
Government needs to cut waste and stop spending on things that are not good for the U.S. taxpayer. It's the way it's being rolled out that is causing the chaos, and it's not a good sign for what's going to happen over the next couple of quarters unless the administration changes the way they're operating.
Exactly. So let's bring this conversation right now into Q3 as we're eyeing Q4, which obviously is the retail sector's big quarter. So what are you seeing in terms of consumer behavior at this moment? Inflation is stubborn. Obviously, we have really significant import rule changes coming up. August 29th is a big one, if we want to get into that. So what is all of this doing to retail, especially as we're looking at holiday?
Yeah, I mean, look, we're seeing a tale of two cities here right now, where we're seeing the lower and middle income consumers hunkering down. They're not spending at levels they were before, and they're hunkering down, one, I think, because of the uncertainty the job market's creating, two, because of the inflationary impact of interest rates, which is eating up in their balance sheets and disabling them from buying used cars and homes. And both of those things, by the way, in the most recent inflationary report are going up in price. We're seeing the middle and lower income consumer really hurting. And again, with unemployment creeping up, I'm not sure if it's going to get better anytime soon. Now, the higher income Americans continue to be resilient because, again, if you think about it, right, when you have a higher amount of wealth associated with your balance sheet, a couple of percentage points are not as impactful to you. So the sale of luxury goods and things that sort of higher income Americans are spending money on, we are definitely seeing resilience on. But everybody else, we're starting to notice that there is absolute shakiness in the consumer.
Absolutely. And so we've seen companies like Under Armour reporting or bracing for a $100 million tariff hit. So if even companies with their size, their scale, their reach, their volume, if they're even starting to see signs of weakness, what can we expect for smaller retailers without that scale?
Yeah, I mean, look, the unfortunate news here is that the smaller players are going to be hit even more. Because if you think about it, right, if you're Under Armour and you're the biggest or the top five biggest customers of a factory in China or the Philippines or Bangladesh, you have some negotiating power. You can say to them that, hey, you have to eat part of the tariffs. You have to eat part of the cost increases. Otherwise, we're out. And imagine if a player like Under Armour, with all of their negotiating power, is talking about $100 million tariff hit. What do you think is going to happen to the smaller players? They do not have that negotiating power with the manufacturing facilities around the world that are now basically going to say to them that, hey, I'm already eating 5% with Under Armour. I'm not going to eat anything with you unless you buy more from me, right? So this is actually, in some cases, going to be a death sentence for a lot of these small businesses because their ability to negotiate is already not there. Combine that with higher interest rates, combine that with a weakening consumer, combine that with sticky inflation, combine that with a rising unemployment rate, um, second half is going to be rough, and I'm sorry to say this, but it feels pretty self-induced.
It sure does. And I think before we even get to a death sentence for brands, it's sort of a death by a thousand cuts. It's okay, maybe you cut a little bit of payroll. Oh, maybe you close a store. And then, at the end of the day, you have no choice but to go out of business, right?
Yeah, I mean, look, it's the backbone of the U.S. economy forever has been the small business. And entrepreneurs of our country are the ones driving it. It is really disheartening to see that the policy shifts and the volatility of the policy shifts is impacting them the most. And like I said, unless something changes radically in the near term, it is hard to imagine how they could be successful or be set up for success in the second half.
Yeah, exactly. Now, the Trump administration loves to talk about reshoring, bringing manufacturing back to the US. How realistic, though, is that as a solution in the short term?
Yeah, I mean, look, it is not a realistic solution in the short term. I mean, it takes on average 24 months to 36 months in the best case scenario to build the molds that are required to manufacture. It takes 3 to 5 years to get economies of scale. And oh, by the way, this all of this is actually built on this thesis of having access to labor, which is willing to, labor that is willing to work in these environments. And, that's another topic that I want to bring up here, right? That is, if you think about it, the combination of all the factors that I spoke about earlier, you add the immigration policies of the administration, where it's not about the legal or illegal immigration, it's about the amount of fear that's being instilled. We have a investor who has a massive, farm in California, and they employ all legal workers, but the farm next to them was recently, invaded by Homeland Security, and that's where one individual, lost their life. Um, he ended up losing a lot of employees, even though they were legal immigrants. They just don't want to work there anymore, right? So how are you going to build a manufacturing infrastructure to compete with the rest of the world when you don't have a supply, strategy around labor? So I mean, look, it's something that these are all problems that can be solved very easily by being a little bit more thoughtful and strategic about how we're launching and rolling out some of these policies. Again, is illegal immigration a bad thing for the country? Of course it is. Is the U.S. debt out of control? Absolutely is it. Is the government wasting money? Absolutely it is. But how we're going about fixing those problems, it just doesn't make any sense.
Yeah, so if reshoring is not really something that's tenable at this moment due to the policies around it, especially around immigration, should supply chain be a top priority for brands right now and optimizing their supply chains?
Yeah, I mean, look, I think regionalized solutions, having access to infrastructure and scale is something that's extremely important for a lot of these retailers and brands. I mean, with de minimis going away, where a lot of these retailers were able to ship out product from Mexico and skirt some of the tariffs, which again, I think is the right thing to do, because why should there be a loophole? Um, if imports in directly to the US are being tariffed. So I think that was actually a positive move from the US government. But from retailers' perspective, they've got to now start figuring out, is it worth sending my product out of Mexico to the US and paying the extra shipping costs, and having the product being delayed by 1 to 2 days in the best case scenario, and 3 to 4 days in the worst case scenario to get to the consumer? Is that what I really want to do? Or do I want to tap into a scaled operation in the United States where I'm closer to my consumer? I can have lower shipping costs, which will more than offset all of the pressures from tariffs, and lower labor costs in Mexico that these retailers are seeing. So, our advice to a lot of these brands that are continuing to ship out of Mexico, and hoping that their cost basis continues to be better, arbitrage against the U.S. cost basis, is to move a lot of those supply chains into the United States.
So that's actually the perfect segue. So in addition to, I guess, Mexico-centric strategies, what advice do you have for retailers and brands as they're kind of navigating this whole climate into the holiday season?
Yeah, I mean, look, I think number one, they really have to start thinking about their consumer, and obviously that's something they've always done, but now more so than ever. And here's why: the wallet is shrinking, and consumer spending is going to be declining. So not everybody is going to be able to get their share of wallet. And for you to be able to get their share of wallet, you have to focus on the fundamentals. You have to offer these consumers the right price. But as we all know, inflation, interest rates, tariffs are gonna make that hard. So what can you do? You can get closer to them. You can ship product faster to them. You can surprise and delight them. And with shipping and speed being a competitive advantage, maybe you'll be able to offset some of the pricing pressures and win consumers because there's not going to be a lot to win from this year relative to last year. We're seeing a shrinkage of how the consumers were spending.
Mhm. And I think we're going to see a lot of bare shelves this holiday, right?
Again, because a lot of these retailers, number one, when Q1 happened, they sold out of their inventory because everybody wanted to buy the non-tariffed inventory. In Q2, they sort of paused their massive buys because they wanted to see where the tariffs are going to land. So it's creating supply chain shocks a little bit, right? So we are going to see a lot of out of stock, which is just not going to help.
Sounds like it's going to be a holiday to remember. Well, Omer, it's been a great conversation. Can you wrap this up with one final takeaway?
I mean, look, my final takeaway really is that the beautiful thing about the United States and our economy and our consumer is that they have been resilient through very, very big challenges in the past. And I think that continuing to invest in the right areas to improve your customer experience is the way to go. Thinking about divesting on things that matter as painful and as hard as it is right now is not the right strategy. So I would suggest that retailers really need to think about investing in a US infrastructure, getting closer to their consumer base. And I think they'll be able to survive the next few quarters as our administration figures out the stabilization of the tariff environment, and the Fed Reserve hopefully comes out with a couple of interest rate cuts.
Well, I certainly hope you're right and I appreciate your optimism. And thank you so much for a wonderful conversation.
Thank you.